Okay, this is for education. I want to just quickly go over how to use these zoom charts to model out what's going in the market so you can get a feel for it. So the first thing that's really important here is looking at what we have. Now there's really four indicators that you need to pay attention to. The first one is what's marked out here is VEL, or velocity, and that's this white line. The second one is this one, it's decay, this number, and this line. The third one is trapped orders. It's the coloration of these bars here and here and here. And the last one is tension, which is this line here. And the 30 minutes, the one we're going to pay attention to for this video. So what you're going to want to do is model out. You want to be able to model out what the participants in the market are doing. So this is going to be a very broad overview of how to look at them using these four tools. And if you want to use these tools and you just popped into this video, you can go to the Zoom, which you can message me on Twitter and I'll give you the password to get in, or it's posted on the Discord. So the first thing you'll want to do is you want to look for participants. And the way we look for participants is pretty simple. This line here, this dashed line here, is 0. So it says -1, but close enough. It's a 0. And again, on here, it's going to be 0. We're looking for 0 tests, and they're marked right here. But the algorithm is pretty aggressive about marking out where it tests 0. There isn't one on decay, so you just have to eyeball it where that we cross over. What you want is to see it cross over. It's important that you get over. If you're watching for velocity to get to 0, you want to make sure that if you see it actually come up and get through 0. So you want to see a +1, and it'll mark that. Same with decay. You don't want to get close to 0. You want to get over 0. So you got to see it go down to -1%. So we'll check for 0 tests on velocity and decay. And you can see those marked here on this one, 0 tests. And then we have a 0 test here. This one didn't quite get there. Here's a 0 test. This is noisy. You want to see it get away. 0 test. Potential, you have to use your brain to think, is this a 0 test or not? I like to see things move away at least a little before I start grabbing 0 tests. Otherwise, this kind of stuff where you have a test, a test, a test starts to just look like noise. The best ones are the ones that are nice and clear. They work perfectly. There's no issues. Okay, so that's the first part of this, the 0 test. So let's track this. The first one on yesterday's. Well, there's one today. Let's do that one. The first thing you see is it crosses over 0. So this is the first thing you look at. At that moment, you have the 0 test, and you want to look for, now we're going to look for the volume. And this is trapped orders. So you see the bars turn green here? So you want to see, first you want to see the test, then you want to see the volume. They're not just things that work together, happen near each other. You want to see them in sequence. So this one, then that one. This is a sequence. So this is the signal. You have a crossover, the volume happens, and then once that volume's done, so you can watch this. This indicator is the trapped orders as well. So you see this is green? So what it's doing is sort of estimating about how long it'll be before that this volume gets finished. And it's trying to give you a sense about whether we're close or not. So 6-7%, a bar or two, maybe this goes like this and then finishes up. And then at that moment, then the volume's done and you have the second part complete. So you can see right there, the volume finished, the signal finishes, and then That's the volume part. So same with trapped order, or sorry, velocity. We come down, you want to see it hit, and you see right in here, we have our first one. There was a singular bar there. You could have just said, well, I'm not going to grab that because it's too close to the signal. You want to see the signal, then a response. You could have waited for this. I have no problem with that. Even though it's a couple minutes after, they're not really lined up super well. Either one. Then once the volume's finished, then you have those two steps done. So 1, the signal, 2, the volume, 3 is the response. You want to see how the market reacted. What we're trying to do is model out big players. And if a big player picks up a position, you see a response. You want to look for responses. So you have to have a response in order to consider it a position. Now the goal here is not to find a signal and to try and trade it and to say, oh, it worked, it didn't work, anything like that. The goal here is to figure out what is going on so that you can have an opinion about the market. Okay, so we find our signal, we find the volume, we look at the response. What you don't want to see is the market have no response, because then that tells you nobody did anything there. So having this move up is good. You could give that a check mark. So that's the third thing. The fourth thing, and by far the most difficult to get your head around, but the most useful, is tension's response. You see, if you have a bunch of money come in and buy into this position, sure, price will move, but they'll also move the New York Stock Exchange tension. You'll see tension curl in one way or another from that. So you can see right here yesterday, you see that was yesterday, this is yesterday. Right here, we were pretty flat, and then after that second blip of volume that we were looking at here, you start to see the market tension rising. That's a good thing. That shows you that they were bullish, that they picked up some longs. Now, it doesn't mean the market's going to just launch into the sky. It means that you have effectively detected an institutional position, and now you know something. And knowing anything is huge in trading because nobody knows anything. Nobody knows what's going on. So once you have these four things, the signal, the volume, the response, and their impact on tension, you could say, I know right here, and I'll even mark it for today, that there was a position right there. That's where the bulls bought. So we can say things about this position. We could say, well, if they're going to get out, maybe look at where would you dump? I'd say probably about here. That's where down yesterday's little thing, a little pivot there. I usually just eyeball this part. Where is the market broken to you? And you just kind of look at it. Usually something makes good sense. Mark it out. Don't question it. Just leave it as your model. Okay, so you could see again, or right here, we had this as zero test. So there's one. Here's another one. We got the trapped orders, and look at this response. So this group of traders, they definitely here, but look at tension. No response. There's an X on that. So we now know that the bulls have failed to impact tension. So they failed. They failed to have an impact on the market. They didn't impact tension. So this is our first data point. This is just one data point put together with these 4 steps. Now we see the second one come in, and you could have, as this one built in, you see the tension, you see decay. You say, well, they failed right here. That's not good. That means that the bulls are not active right now. So we're not going to participate with a side that's not going to play. So now we have a data point we can look at for today. We can have this second data point. We have another bullish sample. That's called a bull sample when you have it on this side. We could say they're not going to play. We expect them to not participate now. We've seen that they didn't want to do it before because they had no impact. Even though we had all the parts and pieces and price moved, there was no impact. So that's the key. Number 4, I think, is just so important to pay attention to. You have got to not believe that just because price moved that matters. This is an index-wide measurement, so their impact. So now we know, well, you're not going to play. Now we see the second sample, and they're not playing it. It's sliding down. Now, kind of what you'd be expecting is a lot of people trying to track this. So you'd look, there's going to be a huge group of shadow traders, the ones that try to play with institutions, and they're going to act just like institutions, but shadow traders lack the ability to impact actual markets, tension. So we know that they will probably liquidate, get stopped out the same way that an institution would. So, this little pivot here, it looks like we dipped down right there, probably hit their stops. Now, we have only seen really one side play today, haven't we? We saw a bull sample here and a bull sample here. What about bear samples? I wouldn't really consider this a bear sample because it wasn't really under zero much, like this is under and then it comes up and samples, or, it's down and then it comes up and says, this is just, it was in the middle of a bull sample. Now, what you could look at is this, right off the open, and I watch these all the time. You see them right off the open. We have it crossing under, crossing over. We sometimes look at that too with velocity, where the previous day will close and it'll open lower. And you can look at that. Now, you got to take that with a grain of salt, but you can use that as a velocity or decay test. And then you can look at the volume. And in this case, you can see right here, crossed above, here's some volume. Tension was impacted. You see that? Price, on the other hand, was not doing so well. Now, it's really important for one side to win, for another side to lose. So if there are traders here, which I'm always really skeptical to use early, right off the open, this is something I'm slow to respond to, very slow to respond to. And then we have bulls here. And we see the bears are doing much better. The bulls are, well, failed. So the bears are looking much better. So what you could say here is, well, the bears are impacting tension. So they're having a broad market effect. All the stocks are configuring so that tension is moving down. These guys are going to get liquidated. So you can almost use this as a target and say, well, we know the bears are here and the bulls are not. So having this push down is a sensible thing to do. You wait for those bulls to come in. Now the bears have somebody to hit. The bulls have another sample. They're not playing. Now we know what's going on here. It's starting to have more sensibility. You can make the reasonable expectations around this. We know the bears are playing. We know the bulls are not. And the bulls just showed that they completely failed to hit this position. So why wouldn't the bears continue? So we have 4 steps to model these guys out. You can take a look at the zero tests on decay and velocity, so both of them. Then you track their volume. So you need to see the signal, then the volume, then the price response. And on top of that response, sort of usually around the same time, you look for tension. Now, tension's response can be nuanced. So can the price response. We see that here. Price response can be somewhat nuanced. Why didn't bears shove this down? From my perspective, because they didn't have any bulls to liquidate. So pushing this down was pushing against who? The bulls showed up. The bulls showed us there was failure. These bears are now more motivated. Your action wouldn't happen until after you saw the bulls screwed up. You wouldn't be acting until you're like, oh, these guys are screwing up. The bears are not screwing up. And as it moves down, you'd probably want to try and act here. That would be the way that I would look at this as a model of the market. So moving forward, what you want to do is keep track of these people, these groups. Okay, so the last thing that's important to note as we look at this is the concept of liquidation. That's not liquidation. And liquidation essentially is a bigger player getting stopped out. That's the way I'm using this term. There's a lot of different ways to use it. That's the way I'm using that. What does that look like? Well, we want to see this group get liquidated, right? These guys are attacking these guys and they want to liquidate them. What does that look like? The easiest way to spot that is eyeballing acceleration in tension. So if we look here, right here, there's an acceleration right there. It's usually somewhat a little bit subtle, but if you're looking for it, you can usually see it. You see that just a little acceleration. We're moving down. You want to see this just curve down. And that acceleration shows you that their position, so this one, you know, if they get liquidated, they're going to dump, and that's going to change. It's going to change the tension for just a moment, just a bar or so. And that will be the liquidation. And it's important that this group that you're tracking is, you know, they're doing better, that they have someone to liquidate. It's just not common. It just never happens that we just see bears just shove. It just, bulls and bears just, what they'll do is they'll trap in a group, stop them out. Right? Trap in a group, stop them out. Trap in a group, stop them out. So you have a trap, stop, trap, stop. So right now we're looking for acceleration and tension. And then once we see that acceleration here in tension, which I would argue we've seen here, then what you want is to see the bulls. What we're going to do then is start looking for where can they find more bulls to trap and liquidate. And that's the way you pump tension. That's how you move tension in a direction. Either way, you can't just move it up or down because that means you're doing all the work. And then you could get this overall sense, you know, throughout a day. Maybe, and this is not true. I'm just going to, you know, maybe through this section, you see that the bulls, they're winning. Let's say that they trapped in some bears and then they liquidated them here or something. Let's say that that's, and then the bulls maybe screw it up here. The bears get motivated and pump it down, you know, and then you would say this is maybe like a transition. And then maybe through here, you might say bears. And you get this overall sense of the market. That's the whole objective here. It's not to find signals. It's to say what's going on. Right now, you could easily say that the bears are liquidating the bulls. That's what's going on right now. Now, there is some nuance and other things to know about tension to get good at this, you know, to be able to do things like predict what's probably going to happen. That can come with time. The first thing that you need to get good at is spotting where the participants are at. And today, I see 3 spots, and that's it. The next spot that I think makes sense is we get velocity to lean up. We get a sample here. Decay could come up. We get a sample here. Those could provide moments of liquidity that you can look at to model these behaviors. Now, there's a lot more, but there's a lot more to get out of these charts, but this is the basic fundamental that you need to learn to do over and over and over. It's the same story every day. You get some party comes in, they're doing better, the other party fails, they stop them out, and that's the way the market works. It's just day in and day out. It's pretty repetitive. So if you can get good at that, and you can mark out where they are, then you'll be able to use the zoom charts to have a narrative, I guess, for the market. What's going on? So you have this overview of the market. So when you make decisions, you can look at that narrative and understand, oh, well, this push down has to do with these bears liquidating the bulls. This push up has to do with the bears getting a further position or finding bulls, or, you know, they were doing well or they weren't doing well. They were successful, they failed. And then over time, what you should find is it all starts to make sense. And you're able to see what's going on and why things happened, and basically forecast what's probably going to happen next. If the bears, I mean, if you think about it, you say if the bears are doing well, let's say our first premise is the bears are doing well, bears have a check. Yeah, and the second premise here is the bulls are failing. well, then you can sort of deduce, or you could deduce that this is going to move down, right? Like you could say that. But you need to make sure you have evidence. Like you have to see this stuff happen. You can't just say, I think it happened. You have to say, here it is, there's the move, here's the response. It's, I have evidence. And then you can use those in your deductions. If you don't have evidence, you don't have a sample, you don't have the volume, it didn't work, you can't make deductions off that information. So the whole point here is just to try to model these out so that you can make deductions to help you see what's going on in the market. And then as you're trying to do whatever your regular trading activities are, you can watch this to help with timing, to help understand what is moving markets in directions, to figure out potentially where they're going, like moving down past this low, I think reasonable for the situation we had. And then once you get there, you can make decisions about what you're trying to do. Do you think that these bears stopping out the bulls is going to cause it to pop back up? Do you think them is going to cause us to just go lower? Where would the bears and bulls be? How could we test them with decay or velocity? You can make all these assumptions after you understand what's going on. That's the whole point of these Zoom charts. Okay, I hope this was useful. It's an attempt to hopefully get you a foot in the door with using the Zoom charts and really basic usage of them. If you have questions, you can shoot me questions on Twitter, join the Discord, ask questions in there, and hopefully the Zoom charts can be useful. All right, see you later, guys.